Welcome to The Explainer. Okay, let's dive right into this. Today, we are fundamentally rethinking something that most of us have treated as an undeniable gospel truth for decades: traditional S&P 500 passive investing. We are currently right in the middle of a massive AI boom, and the old financial rules, well, they might just be walking us straight into a trap.
You know the drill, right? We've all been taught that buying an S&P 500 low-cost index fund provides this perfectly safe, broad safety net. The conventional wisdom says you own a tiny piece of 500 different companies, so if a few of them fail, you're still protected. You're diversified. But looking at the recent data, we really need to pause and ask ourselves, is your passive income truly diversified anymore? Brace yourself for this reality check. Believe it or not, for every single dollar you invest into the S&P 500 right now, 40 cents of it goes straight into just 10 massive companies. That's right, literally almost half your money is tied up in a tiny, tiny fraction of this supposedly broad index. The market is just incredibly top-heavy right now. The vast majority of those 500 companies are squeezed into that leftover 60% slice. And to put a really sharp point on it, NVIDIA alone captures 7 to 8 cents of every single passive dollar you drop in. That is an absolutely wild concentration of risk placed squarely in the hands of very few tech giants.
Section 1. The AI market trap.
So what is pushing these specific companies to such astronomical heights? Well, it's aggressive, unprecedented spending on artificial intelligence. But here is the massive catch. To actually justify their current valuations, these AI-focused companies would need to pull in around $2 trillion in revenue. $2 trillion! To put that into perspective, that is more than NVIDIA, Microsoft, Apple, Alphabet, Amazon, and Meta made combined in 2024. They're being valued strictly on future expectations, which are currently being funded by a literal mountain of debt. The really crucial thing to understand is that this creates a massive feedback loop. As more of our passive investment money flows in, it automatically goes straight to the biggest companies, pumping their stock prices even higher. This gives them an even bigger share of the S&P 500, which, you guessed it, attracts even more passive funds. It's a total runaway train. In fact, data from Deutsche Bank argues that if it weren't for all this current AI spending, the US economy would already be in a recession. Now, why does our passive money flow this way automatically? It's because the standard S&P 500 is market cap weighted. That simply means the more valuable a company becomes, the bigger slice of the fund it takes up. It's a structure that naturally lets these big AI winners completely dominate the index, and it does it without racking up high trading fees. You might be thinking, okay, let's just use an equal-weighted fund instead to fix this. Sounds perfectly logical. But while an equal-weighted fund treats every company exactly the same, which does limit your exposure to the AI bubble, it creates a sneaky hidden problem. It uses a negative momentum approach. Basically, when a stock rises, the fund automatically has to sell it to buy companies that haven't gone up, purely to keep things totally equal. And all that constant trading, it creates high fees that quietly eat right into your long-term gains. Market cap funds, for all their flaws, simply let the winners grow. Section 2. Looking beyond America. So if abandoning market cap weighting isn't the silver bullet, what is? Expanding your investment horizon. Look, it's really easy to think the US will dominate the markets forever because, well, they have for the last 14 years. But think of the global stock market like a giant multi-layered cake representing different countries. Back in 1900, the UK was a massive 24% layer of that cake. By 1990, Japan was the booming layer with cars and electronics, while the US actually struggled. Today, we're in the US AI boom layer. The big overarching lesson here: economic leadership always shifts. No single country stays on top forever. To avoid putting all your eggs in one geographic basket, global index funds are incredibly effective. A single, low-fee global fund gives you instant exposure to over 3,700 companies across more than 45 developed and emerging countries. And the absolute beauty of this approach is that it automatically rebalances itself. If, say, China or India eventually starts outperforming the US in the coming decades, the fund naturally adjusts to capture that growth, meaning you won't miss out on the next global giants just because they aren't headquartered in America. Section 3. The 4 investment zones. Beyond geographic diversification, how do we handle individual market opportunities right in the middle of all this AI hype? We can break the stock market down systematically into 4 zones.
The crowded zone holds those high valuation tech giants like Nvidia. The defensive zone is your stable, everyday value companies, think Walmart or Coca-Cola. Then there's the speculative zone, driven by pure internet hype. Now, what's really interesting about this matrix is that bottom row, the overlooked zone. This is where your small and mid-cap companies sit, and right now they have huge under-the-radar potential with AI. Let me explain why the overlooked zone is so powerful right now using a simple gas station analogy. If one station sells fuel for $1.50 and the one across the street sells slightly better fuel for $3, most people are just going to buy the cheaper option because it does the exact same job. AI models are entering a fierce price war just like that. They're basically becoming interchangeable commodities. So the real winners won't necessarily be the giants carrying billions in debt just to build the models. The true value is going to flow to the small and mid-cap underdogs who simply use those AI models smartly to solve real problems at a much lower cost.
Section 4. The New Gold Rush. Shifting gears away from tech stocks entirely for a moment, let's look at alternative physical assets. History shows us that major technological leaps don't just change companies, they create global instability, fundamentally shifting power dynamics, currencies, and our basic trust in the financial system itself. And that brings us to a monumental shift currently happening with gold. As of 2025, gold has been officially reclassified as a Basel III Tier 1 asset. What does that mean in plain English? It means banks can now treat physical gold exactly the same as cash or U.S. treasuries. Before this, financial institutions simply weren't allowed to count gold's full value on their balance sheets. Because of this new classification, Bank of America recently updated their guidelines, advising that institutional gold reserves should increase from a previous standard of 20% up to 30%. When you combine this massive 10% jump in institutional demand with central banks worldwide, especially China, aggressively building a gold corridor for international trade with BRICS nations, you have absolutely unprecedented global demand for an asset you simply cannot print more of.
Section 5. Why Cash is King. Finally, let's introduce the last and honestly most overlooked piece of a truly diversified portfolio. Take a look at this staggering number. This is Warren Buffett's cash pile as of Q1 2025, $347.7 billion. Seasoned value investors deliberately build and hold large cash reserves. Why? Well, first, holding cash ensures you never have to sell your investments at a terrible loss if life happens or the economy suddenly dips. But more importantly, when market bubbles inevitably pop, having cash on hand gives you the immediate superpower to sweep in and buy phenomenal assets at a massive discount while everyone else is panicking. Ultimately, nobody has a crystal ball. Nobody knows exactly what the market will do next. So the core takeaway from our explainer today is this. Don't completely abandon the S&P 500. You absolutely want to maintain your exposure to growth if AI keeps driving the market straight upward. But you must deliberately diversify to protect yourself. Look into those global markets, the overlooked mid-cap stocks, gold, and keeping some strategic cash. So I leave you with this final provocative thought. If the AI bubble pops tomorrow, or if it doubles in size over the next 5 years, how are you preparing your portfolio for both outcomes? Think about it. Thanks for learning with us today.